Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Update, June 22, 2026. This video presents a direct informational narration of the source document.
So today's explainer is broken down into 6 main sections. We'll be quickly covering the recent macro reversal, geopolitics and oil, tech issuance, the ongoing battle between cloud and hardware, the AI ecosystem and quantum advancements, and finally, some serious AI infrastructure constraints. Let's jump right in.
Section 1. Macro and Market Reversal, specifically focusing on yen volatility and carry trade risks.
Pre-market sentiment was actually pretty optimistic at first, right on the heels of some progress in the US-Iran negotiations. But, within just the first half hour of trading, market sentiment reversed sharply. And this happened without any sudden negative news catalysts, leading to a really rapid decline in equity indices. The only notable anomaly in the market was a sudden sharp depreciation of the Japanese yen, approaching levels we literally haven't seen since 1986, before it eventually narrowed its losses. Markets strongly suspected that the Japanese government intervened. There was a lot of speculation circulating that Japan's Ministry of Finance actually contacted the U.S. Treasury Secretary. This led traders to theorize that Japan might need to sell U.S. dollars or treasuries to support the yen, and that the Bank of Japan could potentially raise interest rates even further. Given the massive liquidity in U.S. financial markets that's deeply tied to the yen carry trade, the risk of a yen unwind directly triggered a wave of profit-taking in U.S. equities and a massive spike in U.S. Treasury yields.
This kind of dynamic suggests that long-term institutional entities, like pension funds, for example, might be executing their end-of-quarter portfolio rebalancing a bit ahead of schedule. JP Morgan actually noted that global equity rebalancing could result in up to $165 billion in selling pressure. That's a massive number. Given that magnitude, institutions are likely distributing this execution over multiple sessions rather than just waiting around for the final day of the quarter.
Ultimately, the 3 major indices closed with some pretty mixed results. The S&P 500 and NASDAQ ended lower, while the Dow Jones Industrial Average recorded minor gains, mostly supported by traditional sectors. Technology sector performance was highly polarized. Major components like Google and Amazon experienced significant declines, which obviously weighed heavily on the NASDAQ. Meanwhile, space-related stock SPX triggered a broader sell-off across the aerospace sector, and software equities remained pretty depressed overall.
Moving right along to Section 2, Geopolitics and Oil Developments, zeroing in on the US-Iran Bürgenstock talks.
So, the first round of US-Iran talks at Bürgenstock concluded with progress that really exceeded market expectations. US Vice President Vance announced that the Strait of Hormuz has reopened and that a long-term mechanism has actually been established to maintain its openness. On top of that, Iran has agreed to invite IAEA inspectors for a return visit. Regarding Lebanon, Vance emphasized the need for appropriate coordination among the parties involved. Iranian Foreign Minister Abbas Araghchi confirmed significant progress, noting that sanctions on Iranian oil have been waived, certain frozen overseas assets have been unfreezed, and a major reconstruction plan has been initiated. Mediators Qatar and Pakistan even issued a joint statement calling these developments encouraging.
Now, despite ongoing vessel congestion in the Strait of Hormuz, which briefly reopened Saturday before closing again from Sunday to present, crude oil markets still experienced sharp declines. Anticipating those sanctions waivers, Iranian crude is entering global markets in massive volumes. To put in perspective, over 30 million barrels were shipped to Asia just over the past week alone. This rapid erosion of geopolitical premiums was absolutely the central focus in commodity markets today.
Okay, on to Section 3. Liquidity and tech issuance. We're talking options expiration and massive capital raising.
While the S&P 500 remains above its 10-day moving average, those minor index declines kind of obscured much steeper drops in individual stocks. Hawkish signals from the prior week's FOMC meeting initially saw a pretty muted reaction, largely constrained by the expiration of massive option volumes during triple witching. But with those options expiring on Monday, market mobility increased, which really amplified volatility. Marginal liquidity is tightening up due to multiple factors: the hawkish Federal Reserve pivot, thin summer liquidity, an absence of marginal buyers, quarter-end pension rebalancing, and aggressive debt and equity issuance by major technology firms. Regarding that capital raising, Morgan Stanley previously projected that global AI-related bond issuance in 2026 will approach $570 billion, literally doubling year over year. Even NVIDIA issued $25 billion in investment-grade bonds just last week. This aggressive capital raising signals a real urgency among large-cap firms to secure funding right now, ahead of potential interest rate increases or further liquidity constraints.
Data from Goldman Sachs Prime Brokerage indicates that hedge funds net sold global equities for the first time in 5 weeks, with the heaviest selling hitting North American and European markets. The short-to-long ratio stood at 1.3 to 1, with net selling across all major regions except developed Asia. And while the VIX remains below 20, its baseline is progressively shifting higher, indicating the potential for a sudden volatility spike in the upcoming sessions.
That brings us to Section 4. Cloud services versus hardware, highlighting CapEx burdens and divergence. Looking at the single stock level, Google experienced a severe decline following the departure of 2 key executives. We're talking about Noam Shazir, Google's VP of Engineering and co-lead of the Gemini AI model, who transitioned over to OpenAI, and Nobel laureate John Jumper, senior research scientist at DeepMind, who moved to Anthropic. These exits really impacted market confidence in Gemini's competitive positioning against GPT, as well as Google's advanced R&D in biological AI. In response, Google Ventures founder Bill Maris suggested that if Google simply reduced token pricing by 80%, the business models of OpenAI and Anthropic would collapse entirely.
However, the underlying driver of the stock's decline is actually the deterioration of Google's traditional asset-light narrative. Since last October, Google has raised $141 billion through debt and equity. Surging capital expenditures caused its free cash flow to drop 47% year-over-year, down to $10.1 billion. Analysts noted that these technology giants are adopting heavy asset profiles that are more similar to airlines. Amazon also experienced a sharp decline, retesting its annual moving average support. And we're seeing severe divergence within the AI space sector structure. Hardware providers in storage and semiconductors continue to capture value, while the 4 major cloud service providers, Amazon, Microsoft, Meta, and Google, bear the heavy capital expenditure burdens. This divergence, which is completely driven by massive CapEx, is increasingly being viewed as unsustainable.
Meanwhile, Microsoft's stock continues to exhibit heavy correlation with broader downside movements while completely diverging during rallies. The stock has traded below its 10-day moving average for 13 consecutive sessions now, showing distinct indications of mechanical selling by quantitative funds. To improve its positioning, Microsoft introduced the Copilot Cowork agent last week, claiming a 30 to 40% cost advantage over Claude Cowork, and even indicated the potential integration of top-tier open-source models like DeepSeek to reduce costs even further. Now pivoting to space-related stock SPX, they saw a significant pullback for the 3rd consecutive session. A low float triggered a liquidity squeeze in the final hour of trading, expanding their losses from 10% to 16.4% and pressuring the broader aerospace sector. While SPX announced a compute contract worth up to $6.3 billion with open-source AI startup Reflection AI, the terms permit either party to terminate the agreement after 3 months with just 90 days notice and 0 penalty, which obviously dilutes the contract's firmness. Furthermore, an Oppenheimer report projected that SPX's net debt could surge by over $400 billion by 2031 due to aggressive expansion. That is more than triple Oracle's current debt load, which really accelerated the sell-off.
Let's transition to Section 5, the AI ecosystem and quantum, looking at structural rotation and policy mandates. Market concentration remains extreme right now. According to Goldman Sachs, while overall U.S. tech equity positioning is near 5-year highs, exposure to the Magnificent Seven has dropped to a 1-year low. Capital is undergoing a structural rotation, exiting major tech names and concentrating into the foundational AI ecosystem, specifically semiconductors, storage, and Asian chipmakers. The quantum technology sector actually rallied against the broader trend following a White House signing ceremony where 2 executive orders were enacted. These orders mandate the development of a fully functional quantum computer for advanced scientific computations within 5 years, and they require all federal agencies to migrate computer systems to post-quantum cryptography by 2031.
In semiconductors, Intel shares advanced 5.2% to a new high. Reports indicate Intel established a deep partnership with UMC to jointly develop 12-nanometer and 3-nanometer processes at Intel's Arizona facility, positioning themselves directly against TSMC. UMC shares surged 14.2%. Visual content firm Getty closed up an incredible 90% after announcing a content licensing agreement with OpenAI. Micron Technology also rose 6.8% after reaching a strategic agreement with Anthropic. While analyst target prices were raised across the board, a UBS analyst advised caution, stating, and I quote, "When fund flows narrow, market breadth weakens, leverage rises, and the rationale for holding assets becomes a self-reinforcing loop, it is typically not the time to add risk."
SanDisk advanced over 4% following patent disclosures of a 3D stacked storage architecture aiming to relegate HBM to a secondary role. Meanwhile, SK Hynix, which commands a 59% absolute market share in the HBM sector, saw its market capitalization surpass Samsung Electronics, making it the most valuable company in South Korea for the first time in 26 years.
Finally, we arrive at our last section, AI infrastructure constraints, where we'll unpack physical bottlenecks and execution risks.
AI data center equities broadly declined today. A research report from Data Center Watch indicated that U.S. data center construction significantly decelerated in the first quarter of 2026 due to very real physical constraints. A prior J.P. Morgan report utilizing satellite imagery analysis found that over 60% of data center projects slated for 2027 completion haven't even begun construction yet, with another 7% explicitly delayed.
So what are these structural bottlenecks? Well, we're talking about severe grid limitations, long delivery cycles for gas turbines and transformers, endless permitting delays, and widespread skilled labor shortages. These execution risks, coupled with high debt loads and continuous chip depreciation, are actively being repriced by the market as we speak. Finally, Netflix is facing potential sector disruption as Google DeepMind announced a strategic partnership and investment with independent studio A24, aiming to integrate frontier AI technology directly into core film and television production workflows. It really leaves us wondering, as these physical constraints collide with rapid technological expansion, exactly who is going to be able to deliver on the promises of the AI era? That wraps up today's explainer. Thanks for tuning in.